Hello everybody, this is Halstead and Andrew McMillan with REH CPA. Today we're going to talk about EBITDA or EBITDA. Some of you small business owners might be familiar with this term and it might be a little bit confused about what it means. Today Andrew's going to tell us a little bit about it, and hopefully you'll come away with this with a better understanding of what EBITDA is. Andrew, can you help us understand when people say EBITDA, what they mean?
Yeah, so what they mean is they want to know a calculation. It's a formula. So they want to know what your EBITDA stands for: earnings before interest, taxes, depreciation, and amortization. So what they're wanting to do is they want to look at your net income from the business, and they want to add back what are your interest expenses, what are your taxes, and what are your depreciation and amortization. They want to add back those expenses to your net income in hopes of having a better calculation of what the true cash flow is of the business.
Right, because amortization and depreciation aren't really cash outflows. They're more accounting entries that don't really reflect actual cash going out the door. So they want that added back.
Correct, because you can't just simply look at net income and say, well, that's how much cash I generated from this business. Right. Because we've done some videos on it in the past. Net income can be manipulated oftentimes to save money on taxes or to defer taxes. We've done a video on even buying a truck, where you can buy a truck before you're in, take a full write-off, which is going to drive your net income really low, and you may not have even fully paid for the truck yet. So net income can be manipulated, so it's not always a true indicator of the general health of your business, how much cash flow your business generates on a monthly, yearly basis. So if a new business, if a potential buyer for a business is coming in, sometimes they want to know what that EBITDA is, because it's a better picture of the true cash flow of the business.
So when you say EBITDA, earnings before interest and taxes. Now the tax piece can be a little bit confusing for people because most of our clients are S corps or partnerships, and they don't really have tax, right?
They don't. So that taxes really only applies to C corporations, because C corporations pay the taxes at the entity level. So it's really not applicable for a lot of our clients, because a lot of our clients are small, closely held companies, flow-through companies, partnerships, S corporations. So if you're a partnership or S corp, you really don't pay any taxes at the entity level, the business level.
And that's where the financial statements are going to be generated, at the entity level, or they're going to be looking at the tax return. So the taxes aren't going to be, because there are no taxes at that level. So we're certainly not talking about payroll taxes or property taxes or anything like that. It's income taxes. So your normal S corp and partnership aren't going to have that add back.
Yeah, you're really just going to add back depreciation and amortization to get
interest. If there's any loans on the business, interest.
Yeah, and they like to add back interest just because businesses are financed in all different types of ways. Some people use debt to finance a business, which in return you'd have interest expenses. So that's kind of viewed as an expense that can't be applied to every type of business.
They want to add that back because, like, if somebody has a lot of money and they're just going to pay cash for it, they don't care about the interest because that debt's going to go away.
Yep.
Awesome. Well, great explanation, Andrew. If you guys have any questions about EBITDA or how it affects your business, or if you're looking to sell a business and somebody's asking you what the EBITDA is and you want to understand that better, feel free to give us a call and we can help you out. I appreciate it. Thank you.